Good afternoon, everyone. It's Monday, the 19th of August. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. Thank you so much for joining us. It's Jackson Hole week this week. Investors are looking forward to what the Fed is going to do in terms of interest rate cuts going into the second half of this year. Markets have been advancing on the hope that the US will have a soft landing. In fact, we saw Goldman actually cutting the recession risk for the US to 20% from 25% just a couple of days ago. Now, all of this will have an impact on our markets in this part of the world. And we're going to talk about that. We've got Jarek, who's joining us to talk about why all is not well in the tech sector, in the upstream in Singapore right now, and why he's downgraded AEM to a sell. But on the other hand, contrastingly, we have Husseini, who's joining us to talk to us about why the downstream tech sector in the internet side is actually seeing improving prospects, and he's going to be telling us why. We also have two stocks which have been upgraded to trading buys by chart guys. So do stay with us till the end of the show to find out. But first, let's talk about macroeconomics. Singapore's July non-oil domestic imports, or NODX, surged 16% year on year. This is the strongest surge we have had in 6 months. On a seasonally adjusted month-on-month basis, NODX actually increased about 12%, while the previous month we actually saw NODX declining about 0.4%. The expansion was actually fairly broad-based, with electronics being the key contributor. Electronics was up about 17%, and non-electronics was up about 16%. We saw exports going to the US, to Malaysia, to China, all surging last month. So this is actually giving our economists a lot of confidence that the recovery will be sustained going into the second half of this year, and they're maintaining Singapore GDP numbers at 3%, which is actually at the higher end of the government's forecast. A lot of this recovery will be centered around electronics as well as pharma going forward. So quite a good shape for the Singapore economy as we go into the second half of 2024. Now, let's turn to Jarek, who's joining us from our studio. Jarek, welcome to the show. I want to talk about AEM. The stocks had a spate of bad news. It's down about half. It's halved in the last 12 months or so. So can you catch us up on what's been going wrong with the stock?
Yeah, sure, Dylan. So I think it's mainly due to a lack of orders. So I think in the last 12 months, I think Intel has been traditionally its largest customer, accompanying more than 80% of its revenue. And Intel has been doing badly. Since the COVID days where they ordered a lot of testing machines, which hit a high. After that, I think machine orders have been typically quite low. So if you look at Q on Q, year on year, their revenue has been dropping quite badly. And new orders from its new customers, what they have been trying to cultivate, are still not here yet. And it will take quite a long time before the orders actually come to a significant amount. So in the next 2 or 3 years, or even 4 years, you will see that if the Intel orders don't come back, generally AEM's revenue will still be off from the high that Intel gave them during the COVID days, and that is why I think the share price has actually came down and reflected that.
Right. So now you actually cut the target price of the stock by about 45% to $1.12 Sing, and you've downgraded the stock to a sell, which is a pretty punchy call. So is there any additional factors that's driving this bearish call for you?
Yes, so I think that this, if you look at it, earnings is going to be quite bad for this year, for sure. They are only making probably a few $1 million for the company of this market cap. They are sort of bottoming in a way in terms of earnings. Even next year, assuming that the ramp up comes for its new customers, probably 4 to 5 of them, they're only looking at about probably triple-digit revenue. So it's about 100 million to probably about 150 million to 175 million of revenue. And the key thing is that if Intel orders are still not coming back, then you are still looking at, valuations that don't match its market cap. Yeah, so the key thing is whether, Intel orders, are they going to come back? And from the looks of it, it looks like it doesn't look like to be the case, because Intel is still losing to most of its competitors for across all segments, right? Right. So I think that the rationale to hold on to AEM is very low. So, and we do think that there's more downside to come, especially if you're going to have another 2 or 3 quarters of bad earnings ahead, especially in the third Q, where it's going to look really, really bad because Intel orders will drop to close to nearly zero, and most only tens of millions, and the new customers are only ramping up from the 4Q onwards. So that's why, yeah, I think that going forward, it's going to be tough for AEM, and it's better for investors to sell and ship it to something else before we even back. I mean, rather than holding on to it. Yeah.
Got it. Got it. So actually, that's what I want to ask. So is this just the AEM very specific issue, or is this more of a sectoral issue? And what are the other stocks that that you would suggest to hide in?
Sure. Sorry, the internet is a bit laggy, so it's getting cut off here and there. But yeah, so I think other stocks like for us, I think for the Singapore tech space, it's quite sad. I downgraded UMS 1 or 2 quarters ago, and then Venture also just downgraded it recently, listening to a hold. So the only thing I have to buy, which is our top pick, is FRENCKEN. FRENCKEN is still reporting Q-on-Q growth and year-on-year growth, and I think that if you look at the semicon play, its traction with its key customers like ASML and also AMAT is still very strong. And going forward, with good guidance given by the customers, they are looking to do new MPIs with these customers, which is the stark difference from what AEM and UMS are doing. So FRENCKEN looks to be also having a lot of capacity waiting for ramp up from these customers. But even by waiting for its ramp up, the customers are already giving them more orders than a year ago. So we do think that FRENCKEN is our top pick, and that this year they will still do well. And also the outlook, the positive outlook for 2025, it's also still good. And if the semicon ramp ups really comes, in the first half next year or second half next year, FRENCKEN will also be one of the key beneficiaries of this ramp up as well. So yeah, we are still holding a buy on FRENCKEN with an unchanged target price of 1.77, and we think that second half the outlook for FRENCKEN, as guided by the management, is even better than the first half. And also the key difference is that the semicon revenue is expected to be stronger in the second half, which is quite bullish, because in the first half the semicon is actually quite strong, really growing close to 30% year-on-year. And normally semicon has higher margins, so we are looking at also higher net margins in the second half as well. So profitability will likely be stronger in the second half than the first half.
Got it, Jarek. Yeah, so short AEM and long FRENCKEN, that's the trade right now. You can get a lot more of Jarek's views in our newsletter today, so make sure you have downloaded your copy today. Now, just before I bring on Hussaini, I just want to do a quick highlight on Genting Singapore, which I know a lot of you follow very closely. The second quarter results were out, and they were weaker on a quarter-on-quarter basis with lower VIP win rates. And part of this was actually seasonal, because second quarter didn't have Chinese New Year and so on. Now we do expect third quarter, fourth quarter to be seasonally stronger, and we have an all-new, all-suite hotel coming up where the old Hard Rock Hotel was, which is going to be opening in the early 2025. So that should actually attract more premium gamblers as well. Dividends were 2 cents per share, which is actually better than what we expected. And we are keeping our earnings intact and reiterating a buy call on the stock, which is with a target price of $1.10, which is around 40% upside from here. So do keep an eye on Genting. We have a note on that from Samuel in the newsletter as well. And we are still very bullish on this name. Now, let's go to Hussaini, who's just getting set up. Now, Hussaini, welcome to the show, and we're going to be kicking off talking about the internet sector, the downstream tech sector in a way. Now, both Sea and Grab have released their results, and you actually come out much more positive on C. And so what's driving this conclusion?
Thanks, Thilan, for having me. Both C and Grab reported last week. C results beat ours and street expectations by around mid to high single digit levels. It was across the board strong delivery from C's point of view. And if we zoom into various businesses, first on the e-commerce side, Shopee GMV grew by 29% year on year. And that was again ahead of expectations. Management also raised the GMV growth guidance from high teens to now low 20% growth for this year. Noteworthy is also that certain management comments that they see a strong consumer spending or healthy consumer spending. Competition is limited or stable, and management see a limited risk of new entrants like Temu. Okay, so net on the e-commerce side, it is firing on all the cylinders. On the gaming side as well, Garena was equally strong with bookings up 21% year on year. Now, this is the third consecutive quarter of upward growth for the gaming business, and it affirms that the Free Fire is becoming an evergreen franchise. Okay, Free Fire remains the most downloaded game globally with more than 100 million active daily users for the game. So on the gaming side as well, very strong delivery. So on the back of this strong results as well as the forward guidance, we have raised our earnings estimates by 9 to 10% and our target price by 7%. Our new target price is 96 USD, and we reiterate our buy on the name.
Got it, Hussaini. So what about Grab then? I mean, I know you've got a non-consensus hold on Grab. So is it should we just ignore the stock?
No, it's a bit difficult for me to say that we have a non-consensus hold. But if we just look into the results was mixed in my view. That's the best I can say. It missed on several fronts. It missed ours and street expectations a fair bit. Mobility GMV growth was decent at 20%, 20, but the deliveries GMV grew just 8%. Okay. And also to note is that the incentives as well as increased both quarter on quarter and year on year. Now, if you recall our initiation, we had argued that Grab is facing both demand and supply side pressure, and because of that, they have to increase the incentives, and that get reflected into the second quarter results, resulting in margins dip as well. Okay, so net a mixed result, and we maintain our non-consensus hold on the name.
Got it. Now, I just want to, go up 30,000 feet and just take a more broader sense. ASEAN internet companies have had a very tough time since interest rates started going up, and they've been embarking on restructuring and cost saving, and not just C and Grab, but Indonesia's, GoTo and so on as well. What's your report card on this? Do you think, how is this actually going? And do you actually see this as a positive development?
Yes, Thilan, we did see some restructuring. In the recent month, we had seen with GoTo, as you rightly pointed, in Indonesia. But that was mainly on the back of the merger of GoTo's e-commerce business, which is Tokopedia, with TikTok Shop. So that restructuring was on the back of that. Now, yes, at the broader level, to your point, we had seen a fair bit of restructuring, as the interest rates have gone up and capital raising has become an issue. companies have cut down on the cash burn. Okay, and that has resulted in a fair bit of stability in competition. And especially for the e-commerce companies, they have increased their take rates and things like that. So net positive. We had also seen a fair bit of consolidation on the back of that as well. Okay, so and the one we discussed, Tokopedia merging with TikTok Shop. We had also seen some consolidation in the food delivery and on-demand services business side as well. So those are the reflection of that. But having said that, what I see at this point in time is that companies are refocusing on the growth side again, and focusing on improving the customer experience, investing in technology, as well as investing into competitive mode. So yes, restructuring has taken place a fair bit, and at this point I see that the strong players like C Limited again focusing on growth.
Right. Got it. Now, I just want to, we're just aware of time, so I just want to turn to telcos, and we saw STARHUB actually coming in with a pretty decent set of numbers, and there was also some changes at the top as well. So can you catch us up on that?
Yeah, so STARHUB posted a decent second quarter numbers with earnings up 8 to 9% on an year-on-year and quarter-on-quarter basis. And if you see the first half run rate, it is in line with ours and street full year expectations. So a decent result. If we zoom into the results, enterprise revenues were particularly strong, led by cybersecurity and managed services business. Consumer side was bit soft, but we do see early signs of stability within that business. Okay, but overall, enterprise plus consumer, I would say a decent delivery. Costs were well controlled as well. Now, we maintain our buy on the name. Company offers 6% dividend yield. Now, going to the CFO change, admittedly, it came as a surprise. Okay, now company only posted their result last week, and they hosted the analyst call. And in that analyst call, there was no mention of the CFO change. Okay, but all of us on Friday, the announcement came in, and it was quite surprising to me. Then they also announced a new CFO as well, which is Jackie Low. Jackie served as a group CFO of Indonesia's GoTo previously, and has around 25 years of experience in finance and accounting. But net, the outgoing CFO's resignation came as a big surprise.
Got it. So that's something we need to kind of keep an eye on. Okay, lots of moving parts in internet and telcos. So thank you very much for clarifying a lot of that, Husseini. Thanks for coming on the show.
Thank you.
Now let's turn to technical trading ideas. Our chart guy has two stocks up on the board. One is OCBC. He's got a trading buy on the stock. The share price has had a big tumble in the especially post results, but he thinks that the momentum now is on the other side, and you should start to see the stock re-rating back upwards. We also have a trading buy on ValueMax, which is a pawnbroker. The share price has actually surpassed its previous high, but our chart guy thinks that it can go even higher. So do have a look at those charts in our report today. With that, let's go into upcoming dates. Quite a few macro dates coming up. We still have SATS to report. In Singapore's inflation rate coming out on the 21st of August. And we've got a few other results also out towards till the end of this month. So do watch out for that. We will be covering quite a few of those in our weekly show as well. In terms of events, we've got two that's coming up. First is Netlink NBN Trust. which is a virtual event with management, which will be on the 22nd of August. And also the big one, which is on the 22nd of August evening with SGX, where Jarek and I will be sharing the outlook for Singapore, as well as some of our top small cap picks as well. So seats are limited, so do sign up ASAP on that. With that, we've run out of time. Thank you so much for joining us as usual. Thank you so much for your support. See you next Monday and have a profitable trading week.